Middle East war, oil shock, gold, stocks. What happens next? If you have been watching the markets today, the message is very clear. The world is trying to price two completely different futures at the same time. On one side, we still have war headlines, military strikes, drone attacks, threats around the Strait of Hormuz, and growing regional tension. On the other side, we now have markets suddenly betting that this conflict may end sooner than feared. And that is exactly why stocks are jumping. Oil is pulling back from extreme levels, gold is moving in a more complicated way, and traders everywhere are trying to decide one thing. Is this the beginning of real de-escalation? Or just a temporary relief rally before the next shock? Right now, the biggest issue is still the Strait of Hormuz. Why? Because this is one of the most important energy choke points in the world. A huge share of global oil and LNG passes through it. So when the market thinks Hormuz is at risk, oil spikes. And when oil spikes, that pressure spreads everywhere. It hits inflation. It hits transportation. It hits airlines. It hits manufacturing. It hits consumer confidence. And it also changes what central banks can do next. That is why this is not just a geopolitical story. It is a macro story. It is an inflation story. It is a stock market story. Now here is what changed today. Markets started reacting to signs that the war may not become a much larger long-duration conflict. Reports suggested that the US believes the military phase could end within a few weeks. That immediately changed risk sentiment. Asian stocks moved sharply higher. European stocks rallied. Wall Street also had a strong rebound. And oil, which had exploded higher during the conflict, dropped back below or around the $100 area. So what is the market saying? The market is saying this. If the conflict cools down, if Hormuz disruption eases, if oil stops exploding, then the worst-case inflation shock may not happen. And if the worst-case inflation shock may not happen, then equities suddenly have room to breathe again. This is why you saw such a strong move in indexes. It was not because everything is fixed. It was because the market started repricing the probability of disaster. But here is the important part. That does not mean the danger is gone. Because even while markets rallied, the region still saw new attack headlines, new military warnings, and continued uncertainty around energy security. So for me, this is still a market being driven by headlines, not certainty. Let's break it down asset by asset. First, stocks. Stocks like lower oil. Stocks like lower inflation risk. Stocks like any sign that the war may be contained instead of expanded. That is why travel stocks, banks, and risk assets reacted positively. Tech also benefits because when panic fades, money rotates back into higher beta names. If oil keeps falling and diplomacy becomes more credible, this rally can continue, especially in growth names, cyclicals, airlines, and consumer-linked stocks. But if the war headlines turn negative again, then this rally can reverse very fast. Because this move is built on expectations, not on confirmed peace. Second, oil. Oil is still the most important chart in the market right now. Why? Because oil tells you whether the market believes supply disruption is easing, or whether the market thinks this crisis is still spreading. If oil keeps falling, that is a green light for broader risk appetite. It tells you traders believe the shock is being contained. But if oil suddenly turns back up hard, especially if it reclaims higher panic levels, that is the market telling you the danger is not over. In my opinion, oil is still the main barometer here, more important than many stock charts right now. Third, gold. Gold is interesting because people assume gold always goes up in war. But it is not that simple. Gold also reacts to the dollar. Gold also reacts to bond yields. Gold also reacts to rate cut expectations. So even in a geopolitical crisis, gold does not always move in a straight line. Right now, gold is getting support from uncertainty and from a softer dollar. But if markets become convinced that war risk is fading and rate cut expectations change again, gold can become more volatile than many people expect. So I would not look at gold as a one-direction trade here. I would look at it as a hedge that still depends on macro conditions. Fourth, the dollar. If the market becomes more confident that the conflict is contained, the dollar can soften as panic demand fades. That can support gold, emerging markets, and risk assets. But if war headlines worsen again, the dollar can catch a safe haven bid very quickly. So again, this comes back to the same core point. This is still a headline market. Now let's talk about what matters next. There are really only two major scenarios. Scenario 1. De-escalation becomes real. That means fewer attacks, more diplomatic language, less disruption around shipping, and continued pullback in oil. If that happens, stocks can rally more. Gold may stay supported but less explosive, and oil likely cools further. Scenario 2. De-escalation fails. That means more strikes, more regional spillover, continued uncertainty around Hormuz, and the risk that oil reflates sharply. If that happens, inflation fears return, stocks lose momentum, and defensive assets become stronger again. My opinion? I think the market is right to rally on improving headlines. But I do not think this is the kind of environment where you become careless. This looks more like a tradable relief rally than a clean all-clear signal. So if I were positioning around this, I would watch oil first, then headline risk second, then sector rotation third. If oil keeps breaking lower, that supports the bullish case for equities. If oil stabilizes and starts rising again, I would become much more cautious. The market right now is not asking whether the world is perfect. It is asking whether the worst-case outcome is becoming less likely. And for the moment, today's price action says investors think the answer might be yes. But in a war-driven market, one headline can change everything. That is why the next few days matter so much. Watch oil. Watch shipping. Watch military escalation. Watch diplomatic language. Because that will tell you whether this is the start of a real recovery move, or just a temporary bounce inside a much bigger geopolitical storm. This video is for information and education only, not financial advice. Always do your own research before making any investment decision.